Hi, welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. As I've always stated, the purpose of this show is to provide educational content to the viewers. And today's show, we're going to be talking about mortgages. A few weeks ago, I had a guest on my show, and we were talking about first-time home buying. We'd like to really touch upon that, but overall mortgages in general and just how to navigate the system. And with me today is a guest of mine who I'm going to endorse, is the gentleman who actually did my mortgage for when I bought my house 3 years ago, Mike Harvey. Mike, thank you for joining us. Mike is a mortgage professional. He is also one of the owners of Vantage Financial Group, which is located in Pennsylvania. I assume you do work in the tri-state area as well?
Yes, so we're located in Blue Bell, Pennsylvania, and we also have an office in Philadelphia. But then we are licensed in Pennsylvania, New Jersey, Delaware, and Florida. So we do originate loans in all of those different states for residential properties.
Good to know. Good to know. So do you find states differ?
In some ways. Now, from our side, a lot of the clients that we work with that are in states like New Jersey or Florida, they are either across the bridge in Jersey, where it's a little bit of runoff from our Pennsylvania clients, or they're purchasing second homes. Right? Second homes down the Jersey Shore, or maybe a second home down in Florida. Something like that is usually what we run into from an individual purchasing in those states.
Certainly
areas.
Florida, and the Jersey Shore. So curiosity question, I know if I were to buy a rental property, the interest rate on the rental property is a higher rate. Does a vacation home also carry a higher rate than a primary residence?
It does not. So there's not the adjustment for a interest rate that you would see from an investment property for a second home.
Okay.
They do require different down payment amounts. For a second home, you're required to put 10% down on those properties, when for a primary home, you can put significantly less.
Right.
But it's not your normal 15, 20, 25, 30% that you would see for a second home or for an investment property, depending on the type of home that you purchase.
Okay, good to know. Good to know. So tell me a little bit about the first time. I really like to piggyback on that program that just aired last week. I would like to understand a little bit more about programs for first-time home buyers.
So there's a number of different programs designed for first-time home buyers. And some of the most popular ones would be something like an FHA loan, right? FHA loan is really geared towards the first-time home buyer because the government does assume sometimes that somebody who's purchasing their first home might have lower credit than your normal consumer. So something like an FHA loan, it allows you to put as little as 3.5% down on a home. It also allows you to get up to 6% seller assist, which can cover basically all or most of your closing costs that are associated with the transaction.
Did I hear you once say, though, that if I were to get up to 6% seller assist, that it cannot count towards my 3.5% down?
Correct. So it can only cover your closing costs and your prepaid items like your escrows for taxes and insurance. It cannot cover anything that is the actual down payment amount. So if you purchase a home for $200,000 and you do the FHA loan, you'll be able to, you'll have to come out of pocket $7,000 even if you get more assist. Correct.
Regardless.
Yep, exactly.
Okay. But those loans, do they carry a higher interest rate?
Normally, the FHA loans carry a lower interest rate than your conventional loans, but the mortgage insurance can be a little bit higher. So they have monthly mortgage insurance, and they also have an upfront fee, which is tacked on top of your loan. Now, and that's just one of the first-time homebuyer programs. There's a number of other ones. Both Fannie Mae and Freddie Mac, they offer first-time homebuyer programs as well that allow for somebody to put as little as 3% down payment on a home. And those are conventional loans, conforming loans. So those are other options for someone. Now with that, you would have mortgage insurance as well. So depending on your credit score and the type of property you're purchasing, we'd have to see what the ideal loan scenario would be for you.
Right.
And we do work with a number of lenders as well that offer loans that fall under what's called like a CRA loan or a Community Reinvestment Act loan. So the government at one point said, we would like to incentivize banks to lend money to individuals at, let's say, a 3% down payment, and maybe they can get more than the 3% seller assist in certain areas. Maybe those areas are determined by income limits or minority tract percentages, different things like that. So there are other first-time homebuyer programs geared towards getting individuals into the home buying process.
And so these are programs that are carried by certain lenders, or any lender can use one of these programs? How does that work?
A lot of them are carried by different lenders. So from our side, as Vantage Point Mortgage, we're a mortgage brokerage. So that allows us to be licensed to originate loans with a number of different lenders from all over the country. So we could write a loan through Quicken Loans. We could write a loan through a company called Franklin American, who's a Citizens Bank subsidiary. So it allows us to go out and find the right bank that's going to match up perfectly with the right person. And they all offer these programs at a little bit different, I would say that they have their own flair to them a little bit. They have their own appetites for whatever they like to do, and not all banks have the same program. So our job is to match the client with the bank that's going to give them the best loan for their exact situation.
Well, I'm glad you said that, because that falls into direct line with how we like to do business, is to be able to offer up, choice. And inevitably in your business, I generally only like to refer to mortgage lenders who are brokers, because a particular bank may not be the right lender for a particular type of person.
Exactly. A lot of banks have certain appetites for the types of loans they want. So if you have lower credit score, we have some lenders that will offer the same person in their same scenario a substantially lower rate than another lender would, just because those are the types of loans they're okay dealing with. So our job is to find that specific bank that works for that person and make sure that they have all the options that are available to them.
So what are magic credit scores? I hear 660, don't fall below 660 or you're bad credit. I hear 740, I've heard 760. Above that is considered excellent credit. What are the magic scores?
So there's many different brackets for credit scores. Usually when you're above 760, that's the prime bracket that you can fall in.
Considered excellent.
Sometimes individuals say, I'm at 780 and I don't want to have my credit score pulled because I don't want it to fall a couple points. It's not going to hurt you. Once you're above that 760, you're pretty much golden. Now, currently, anything below 700, you're seeing a little bit more of a pushback from the lenders.
Really?
And sometimes the way they would do that is maybe just restrict what your debt to income maximum amount could be.
Right.
So if normally they'll let you go to 50%, maybe they'll say if your credit score is below 700 and you're putting 5% down, your maximum debt to income ratio is 43%, which could limit the amount you can get approved for. Now, as low as banks will go, there are certain lenders out there that'll still go down to 580. Now, the additional criteria they want that person to meet could be more strict than somebody with a 740 score.
They want 20% down, we want a better debt to income.
Yes, it could be a number of different factors, whether it's down payment, the number of trade lines that you might have, compensating factors are another way that they can look at these. So it varies, but technically you can go down to 580, but it makes there a lot more hoops to jump through in order to get the loan.
And generally speaking, they're going to have a higher rate.
The terms are going to be significantly worse. Correct. Yes.
Worse. I like that. Significantly worse. Right. But you want to buy a house, And so, do you know much about how to help people improve their credit scores?
I'm not specifically a credit expert in the sense of I wouldn't recommend somebody calling me to figure out their credit score and teach them how to increase it. But
do you know anybody who is good?
We do have a couple contacts that we do refer individuals to, but sometimes a lot of our lenders, they have systems that we can put someone's credit score into. We can put the report in, and we can generate a report as to what would this person have to do if we need their score to go up a certain amount of points. And then we can advise the person on as to what to do. So your credit score in general is really, the three bulk items that make up someone's score is what's your payment history? Have you made payments on time? Do you have a history of paying things on time? The second one is maybe the length of history that you have. If you only have one credit card that you've had for 9 months, that score is not going to be as good as somebody who's had the on-time payments for 5 or 6 years. And then the other one is the utility. How much credit do you use? If you have a $5,000 credit card and it constantly carries a balance of $4,900,
it doesn't look good.
Banks aren't too favorable of that.
Hey, by the way, I got to tell you the truth, what happens to me every year. I got my business credit card with a limit of 30 grand. It just so happens November of every year, I have to have all kinds of business licensing and everything hits all at once. And I put about 20 grand on my card. My credit score drops about 70 or 80 points for 1 month until I pay it off.
Yeah, and it happens. Credit is one of those funny things that we have to deal with because somebody can be a perfect client as far as the creditors go. They don't miss any payments. They pay their items off just as you do. But sometimes if you have a big month, maybe you plan a family vacation that month and your credit card's bill is a little bit larger than you would expect, it can negatively impact your score, which
Clearly,
if you're trying
with
to buy a
mine.
house at the same time, could impact what the terms would be that you would receive.
So what do? Do you just say, hey, look, let's pull credit 30 days later again?
So we do have the opportunity to do that in a lot of situations. So I always recommend that somebody comes to us well before they find their dream home. So
Right.
we can begin that process to say, this is what you have to do, keep doing these things, or here's what we have to change. And then we have the full picture as to what somebody, what they can qualify for, what the terms would be. And then hopefully we wouldn't have to re-pull their score because your score is good for 120 days. So hopefully we wouldn't have to re-pull their score.
You try to time the pulling of the credit. Well, hint, if you know anybody who is a credit repair expert, and anybody who's watching this, I want somebody as a credit repair expert as a guest on my show, because I think that's something that a lot of people could learn and benefit from in advance of going to see you.
Exactly.
And cleaning things up. You clean up your credit, and it's never a bad thing to clean up your credit.
No, it's never. It can only help you, especially in the process of buying a home, getting terms for a property, or getting terms for a loan and figuring out the types of loans you can get qualified for. Having better credit will always put you in a better position.
Absolutely. Sure. Either better rates, better
options,
terms, more choices,
lower down payment options. All of those items come with a better credit score.
How long does it take to really get someone's credit score to turn around or move?
It depends how
bad it is.
Exactly. Right. It depends what they've done in the past.
Right. To
hurt it.
Right.
Correct.
Okay. So, what other things do you recommend to the first-time home buyer who, one of the things that we referenced in our show is for the actual buyer to do a little bit of their homework first, because I know if you told me today 50% debt to income, that would make me qualify for a house that I can't afford. Do you actually, when you're talking to folks, consult with them in that regard? They say, oh, I can afford a $800,000 house. Do you look at them in the eye and say, are you really sure you want to do this?
So we have clients on both ends of the spectrum. We have some clients, they come to us, and whether it's the income they show on paper or liabilities that they have on their credit report, where they're a little bit shocked that they can't qualify for something that they would imagine they could carry. But we then have clients who are in a significantly better financial situation on paper from a mortgage side than they would imagine.
Right.
So that would allow us to sometimes say to those people, well, how much would you like to pay each month? What's your ideal payment? And if they say it's $2,000 a month, but they can qualify for $3,000, we're not going to push them for that $3,000 number. Then we're going to say, well, that $2,000 probably puts you in this type of range, because a lot of individuals, they get a payment amount in their head before they have any idea what they can actually qualify for.
Okay. Question for you. Just thinking about repairing credit or down payment or is, one of the places to be able to access money is through a 401k loan. And, you can borrow up to 50% of your account up to $50,000. Let's say, for instance, I wanted to use a 401k loan to serve as my down payment. Are they going to be looking at what my new net income is? How are they going to factor that loan? How is that going to play in? I mean, I don't know if you do underwriting, but you have to know enough about the underwriting.
So you're able to use that money, 100%. If
Right.
you have access to that money and you're able to withdraw it, you are able to use that.
But it's going to kill my debt to income.
The banks are not going to hold that payment against you.
Really?
Because you're basically paying yourself back for that money. So they're not going to hold that liability against you to use that money, because you're just paying yourself back.
Okay, that's interesting. So what you're saying here is it may behoove an individual who may be struggling with DTI on paper to potentially take a loan from the 401k to clean some of that up, to be able to make itself available. I'm not saying I'm a proponent of it, but that's a very interesting concept that you're telling me, is it's not considered a debt.
Correct. And one of the things when we initially get someone's application, we ask them questions about, do you have money in an account like that? So that we can get the full picture, because when they come to us, sometimes it's better for them to pay off debt, or
of course,
to pay off a liability that will, a car payment, let's say. If
That's
you
a perfect
have
example of it.
a $9,000, and this is not on a lease, but on a car that you own. If you
Right.
have a $9,000 balance on a car that you own, and that monthly payment is $400 a month, it would take a lot. It would take probably, tens of thousands of dollars
Of
on the
income.
lending side
Right.
in order to borrow $400 of a monthly payment.
Meanwhile, I could take a $9,000 401k loan, not a distribution, a loan. That 401k loan is going to cost me about $180, but as far as you're concerned, I just took a $9,000, $400 a month liability
Correct.
off the DTI.
So if somebody's initial approval is $225,000 of a loan amount, if they were to take out that $9,000, pay off that $400 payment, that could take us to $300,000.
Right.
So it can significantly increase the amount they can get qualified for on the housing side, just because your car loan is over 4 years, whatever that number is, and you're borrowing on the house for 30 years. So
Right.
it's
Well, not to
significantly
mention the
less than
car
tomorrow.
loan may only be a year and a half away from
Yep.
expiring, but you look at loans that if they're going to be paid off within the next 12 months, they're discarded from DTI?
Correct, but not something like a lease. So something like a lease, the bank would assume
You're gonna lease
that
again.
you're going to lease again.
All right,
So
good.
if the car is owned, they will say, well, we don't need to hold this against you because it'll be paid off soon.
Right.
And then it's
Good point.
You're going to keep that car but not have a liability anymore.
Excellent.
Correct.
We're up against our break.
All right.
Please stay tuned. We'll be back in a minute or two after our commercial break. Thanks. That was quick for me.
Have you saved enough for retirement? Are you financially prepared for an emergency or unexpected event? Have you thought about your financial future?
Hi, I'm Mike Menninger, founder of Menninger & Associates Financial Planning. For over 20 years, we have been answering our clients' questions just like these as we develop unique and comprehensive financial plans tailored to meet their needs. When addressing your financial plan, we incorporate your entire financial picture, including taxes, estate planning, as well as investment planning and retirement planning. So call us today for a complimentary, no obligation consultation.
Unique approach to financial planning.
Welcome back to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, and I'm still here with Mike Harvey, who's a mortgage professional and part owner of Vantage Financial Group. Mike, we talked about a lot of stuff. Going back to the first-time home buyers, coming up with the cash. I mean, there's going to be, how can someone come up with that 3.5% cash if they don't have 3.5%? 3.5% of $200,000. If they don't have other money to come up with, and I use a rule of thumb, 3% for the rest of it. They got to come up with the $7,000 plus closing costs. Next thing you know, they're having to come up with 15, possibly 20 grand. What other sources of money can they get? You referencing gifts, what other?
Yep, so ideally an individual would have that money in a checking savings type account.
Right.
Or in a retirement account that they can draw from.
Right.
If not, one common or a few common items are you can always ask for a gift from a family member. All right, if you do have a relative that does have the means to provide you with some assistance to purchase a home, they can always give you that money in the form of a gift, and we can easily document that to be used.
You get an affidavit of some sort.
Exactly. We will get a form signed saying I give money to
Right.
my daughter, whatever the case is.
It takes the responsibility off of you.
Exactly. And then another way is there are different forms of grant programs that are available.
They were saying it.
So a lot of these grant programs can specifically be geared towards certain areas, maybe certain income limits, certain types of properties or borrowers. So there's a number of different programs out there that are designed to give some people down payment assistance in a way so that they can achieve home ownership even if they don't have that cash on hand.
Well, very interesting. Stupid question of the day, which I'm loaded with them. I'm hearing this for the first time from you. And if I'm hearing it, then how does one know? They're a first-time home buyer. They don't know squat, okay? And I don't mean that negatively. It's just you don't know what you don't know. How do they know about these grants? Or are you the one who provides them with the information?
So a lot of borrowers don't know about them. And sometimes we can provide them with the information, steer them in the right direction on how to obtain these. But a lot of times the job is on the borrower, the consumer themselves, to figure out if they can qualify or obtain these types of grants. Unfortunately, there's not much information out there, and a lot of these programs do have limited financing available to them. So at the beginning of the year, maybe they'll have a couple $1 million they can lend out.
First one to the well gets the water.
Exactly. So the programs themselves, they're designed to aid individuals to bridge that gap for cash they don't have, but we can steer them in the right direction as to check out this program. You'll have to go through an application process, probably take a course or so for a weekend, and then you'll be able to see if you can qualify for it.
So the other thing that people could do is they're allowed to draw up to $10,000 from a retirement account, let's say their IRA, and in doing so, they still have to pay the tax on it. It just avoids the 10% penalty, but it's another place to go. And, you know, they always got to be cautious of a few things. Number one, they're going to be paying taxes on it. So when they're paying taxes on it next year, they need to plan for what that tax's impact is going to be. But it's another place to go. And that is one of the things you find oftentimes, or at least I've found, and I imagine you find, one of the biggest obstacles is coming up with the cash.
Exactly. And you know, we do like to work closely. If someone is a referral from a financial advisor, we like to circle back with them and say, they need $10,000. Where would you recommend they pull this money from what they have currently? So it's, you know, using the resources of someone like yourself to figure out what's best for that specific person for where to pull that money from.
Well, it's funny you say that because, you know, there are times where I look at it and say a person is in a very low income tax bracket, probably lower today than they may ever be in, and that if they took the $10,000 out of the IRA and avoided the taxes, they're walking away with the money at a very low cost. If they're in a higher income tax bracket, what I've also done with folks is I've actually literally taken some of their IRA money, pushed it into their 401k, and then subsequently create the loan and pull it right back out again.
And our job is to figure out the type of loan this person can qualify for, what the ideal scenario for them is based upon the monthly payment and cash out of pocket, and then go back to you and say, how do you recommend getting this cash?
Right. So how would you differentiate yourself from, a lot of people think of, I need a mortgage, I'm just going to go to the bank. I mean, it's just sort of the layperson's like, oh, well, the bank is money. How do you differentiate yourselves from the banks?
So as a broker, we have many different lending avenues, which is we can go to many different lending institutions and use the types of terms and programs that they have available to them. Again, as I mentioned earlier, not all lenders have the same appetite, or they don't want the same types of clients. So it allows us to figure out who's going to best serve each individual client. Now, with that, you know, we get into different types of programs, right? If somebody is purchasing a $300,000 home and they're putting 20% down, the loan programs that we're going to have, while our terms could be better, are going to be similar to what you might find at a bank.
Right.
But if that person comes in and they don't have as good a credit, if they have lower down payment options, or if they're maybe purchasing like a jumbo loan, right, which is any loan amount over $548,250, we have a number of different low down payment programs for scenarios like that as well.
That jumbo's gone up. That jumbo was only like $380 not many years ago.
It's gone up substantially over the last couple of years. So.
Yeah, so that's because the stinking houses have gone up so much in the last couple of years.
The prices of homes have really skyrocketed, that's for sure. And
has that made you guys busier, or you're still, you know, I've also heard that realtors are extra busy right now because they're taking their clients to see a house and they're one of 10 people and 9 out of the 10 people fail. Therefore, they have to keep doing this over and over. You're a finite number of houses, right?
So inventory is extremely low right now, which leads to way too many buyers looking at the same exact homes, and it's driving these prices up. Now, home price-wise, that's probably the most important, in my opinion, aspect to the real estate market. Just because rates are very low, it's great. It allows a lot of people to refinance, but what allows people to sell and have liquidity to move from home to home is being able to sell and get some money out of your property. If nobody was able to sell and get any equity out of their home, nobody would sell. So the values being up is the most important part of the market continuing to go.
One of the things I was thinking about the value being up, I think of PMI, kind of like the doghouse, and you understand you're a man. Yep. Easy to get in, hard to get out. So let's say, for instance, I bought my home 2 years ago for $300,000, and I was only able to put 5% down. Now all of a sudden it's $350,000. What do I have to do to get out of PMI? Or do I need to refinance? I would imagine that refinancing has become very popular with you lately because the rates are low. People may have bought. I refinanced the mortgage I did with you 3 years ago because 3 7/8 was the greatest mortgage in the world.
Exactly. So if somebody purchased a home 2 years ago, it's probably more beneficial for them to refinance. One, you can lower your interest rate, and then you can use the new appraised value to get rid of that mortgage insurance.
Exactly.
If somebody recently purchased, and now it is, you can always refinance. We've refinanced people, 6 months after they purchased the property for whatever reason, and maybe they had bad credit at the time.
That's what I've seen before.
They got it up. We've refinanced. But if you don't want to refinance, but you do want to get rid of mortgage insurance, if you have an FHA loan, you're basically not going to be able to do that. They're going to want you to refinance out of that. But if you do have a conforming loan, then a lot of lenders will maybe look, as long as you make 12 payments, that they might allow you to get an appraisal done so that you can use that new value and just get rid of it. So certain banks and servicers, mortgage servicers who you make your payments to each month, they handle things a little bit differently. But if you purchased 2 years ago, put 5% down, the chances are you can refinance now and get rid of that mortgage insurance.
Yeah, and
lower your rate.
because you're just throwing money away.
Exactly.
Mortgage insurance is crazy that way. We are out of time. And Rady, and I know there's a handful of things I would like to talk about, but I appreciate you taking the time. What I'd like to do is do me a favor, take a peek in the camera, tell people how they can get a hold of you. I'm going to give these guys do a great job, okay? Really like the fact that they do the consultative approach. So, Mike, if you could look into the camera and just tell people how they can get a hold of you, that'd be great.
Yep, so Mike Harvey, Vantage Point Mortgage, our website is www.vpmortgage.com, or my email address is mike, M-I-K-E, @vpmortgage.com. Or you can always try myself, 484-919-8976, always the easiest way to get a hold of me, and happy to help answer any questions you might have or help you purchase or refinance, whatever it is.
Excellent. Mike, thank you very much. I appreciate it.
Thanks.
Thank you very much for joining us. I hope that in conjunction with our episode from a few weeks ago on the first-time home buying, that Mike was able to supplement it. But as I have endorsed him a couple times, I wouldn't have used them if I didn't think that they're good. So I encourage you, if you need to refinance, talk to your financial advisor, reach out to someone like Mike, who can really provide you with a consultative approach to making sure that you do it the right way. Till next time, I hope you have a wonderful week, and I will see you on next week's episode. Thank you very much. Have a great week.